Welcome to the Veterinary Technology Podcast brought to you by Sedical. Visit veterinary.com to find your solution that fits your needs.
Jon is taking 10 minutes today to tell us about some financial options regarding the acquisition of capital equipment. It's a good review of the financial tools available today. Acquiring the right equipment with the best financing helps you provide the best in services and maintain the best practice management. So please enjoy this informative podcast.
Hello, my name is Dusty Kelchin. I am the Marketing Director of Great America Financial Services, and we hope you enjoy this short podcast on equipment finance. I have with me Jon Krekelberg from Great America, and Great America is a privately held small-ticket finance company based out of Cedar Rapids, Iowa, and has been in business for 25 years. Jon and I will be discussing leasing versus loan types and structures of financing and other areas to be aware of. Jon, thank you for joining us. First of all, can you explain what a lease is?
Yeah, good day, Dusty, and to everyone that's joining the podcast on leasing. So small ticket leasing, those are typically transactions that are under $250,000, is really a convenience-based finance resource to acquire equipment and software. And what I mean by convenience-based is the application and documentation process is typically very simple. A name and address on requesting party may be all the information needed to approve the request, usually within one business day. And then once that's approved, documentation is usually limited to 1 to 3 pages with terms and conditions. So it's pretty straightforward and easy to understand. Now, leasing is transacted when the leasing company, known as the lessor, pays the manufacturer for the equipment, and then the customer, known as the lessee, pays a monthly payment to the leasing company to use the equipment. Now, the lessor typically takes a security interest, and then oftentimes the lessor has aligned themselves with the manufacturer, but that's not always the case. So this process of easily acquiring the equipment provides many benefits to the customer, including the utilization of tax code 179, which is the accelerated depreciation, where you take all of your depreciation on a piece of equipment the year in which it was put in use. And you also get to pay for the equipment as you go, generating cash for your business. So a lot of good options with that.
Right. So Jon, how does a lease compare to a loan, and what's the difference between the two?
So a loan is typically underwritten by a bank, and while leasing is usually limited to equipment and software, loans can be structured to handle operational items like human resources, working capital items, things like that. Rates from loans may be slightly lower than leases, but while you're making that financial decision, understand where your exposure is with the bank. Now remember, you know that the only resource for those operational items is the bank or your cash flow within your business. So strong consideration should be thought on whether to preserve the capital or tap into that bank line or use a lease.
So what types of lease agreements and structures are the most common?
So most leases in the vet space are written on a $1 buyout, also known as a conditional sales contract. And this structure is very close to a loan where after the lessee pays the agreed number of monthly payments, they then own the equipment for $1. Another variation of that, which is used, is an EFA or an equipment finance agreement. And this product mimics a loan even closer, as the finance company is simply paying the manufacturer on behalf of the customer. So all taxes, insurance, and things like that are really the responsibility of the end user.
Are there other options, finance options available?
Yeah, there are. There are other kind of less used options are the FMV and or purchase option leases. And what those typically do is put a portion of that financed amount really at the end of the lease. So it gives you a lower payment, but then you have to make a purchase option decision at that point in time. And then there's typically have a month-to-month renewal on those. So if the purchase option is not exercised, it will kind of roll month-to-month until you decide. So those are the primary ones. You know, leasing does offer a couple of unique capabilities that banks typically don't do in the case of providing some flexibility on end user specific needs. There's deferrals, there's step payments where you would have, a payment for 6 months and then a little higher payment for the next 6 months. Same as cash options, things like that. just to provide some flexibility on specific needs that you may have.
So with all of these different finance options, is there anything that end users should be aware of?
Yeah, Dusty, one of the things that I really caution people on is make sure you know who your leasing company or lessor is. Today's world really gives you resources to research companies. And as a self-regulated industry, it's really important to do your research to find out who that company is, how long they've been in business, what their reputation is, to make sure they're in good standing, within the marketplace. Not all leasing companies are alike. And once you've done that research, the documentation piece, there's some things that I want to point out today that you should really be thoughtful and be aware of. So a couple of these are interim rent, and this is a scenario where a leasing company calls to change a due date for a more favorable time in the month. So let's say your lease started on the 10th of the month and they say, hey, would you like to move your payment to the 1st? That sounds great, but you are going to pay a pro rata portion for that period, in addition to the 60 payments or 36 payments that you've agreed on in the agreement. So make sure you look out for that. Automatic renewals, there should never be renewals on dollar buyout leases, but check to make sure. And on FMV or 10% lease options, they should be month to month. There are some companies out there that have evergreen clauses that, if you don't exercise your purchase option, it rolls into a 12-month or longer commitment period. So take a look at that. And one thing I really tell people to be aware of, you wouldn't think it would be very, very prevalent, but you should calculate the interest rate and double check what's told by a finance company. And if you don't know how to use it, there's many tools on the internet. There's apps that you can get for your phone to calculate what that interest rate is, but verify that, especially on step payments or deferral options. Make sure you're getting what you're being told. And then lastly, excessive fees. Again, it's a self-regulated industry, so just be aware of that and keep your eyes open.
Right. That's really interesting and very good advice. Jon, if you could summarize everything we've talked about here, and what would you say to end users?
So just a few things. Leasing gives you a tremendous buying power. Using money to generate cash, it's a really good tool. Understand if you're making the decision between loan and lease, what your exposure limits are at the bank. And for a couple dollars different, you can preserve those loans with your bank for items that typically wouldn't be able to be financed anywhere else. So take a look at that and know who you're working with. The information is at your fingertips. Do your research and make sure you are protected as that goes. So that's what I would kind of end with. I hope you guys all enjoyed this podcast on equipment financing. We look forward to providing future education to you all, and have a great day. Thank you.
All right. Thanks, Jon. Appreciate your time. And thanks, everyone,